Okay, good afternoon and welcome back, everyone. Thank you for joining me. Thank you for joining me on a Wednesday as opposed to Thursday, our regular scheduled webinar series. Today, we're here to talk about option strategies for a bear market. And the reason we're here to talk about this is because of the current market environment. And I wanted to illustrate some of the market structure changes that we've seen over the last few years that really affect trading bearish strategies. We see this type of change in some of the back testing that we do as far as scanning for bearish opportunities, as well as back testing option strategies for bearish trades. The performance of trades have really changed quite a bit over the last few years. So today, what we really want to talk a little bit about is what we're currently seeing with pullbacks and corrections in terms of a bear market, because they are simply not just the inverse of a bull market. There's actually quite a bit of difference we've seen over the last few years that have changed when markets sell off, how different they are from when markets rally. So today what we'll do is we'll break down the current market outlook. I want to talk a little bit about the statistics around corrections and pullbacks and what we see is actually different between a pullback and correction and bear markets with what we see in terms of when the markets are rallying or going higher. And then what we'll do is we'll run through bearish option strategies that are appropriate for bearish markets, if you will, and talk a little bit about the trading best practices around those strategies. And today's webinar, we're going to spend about 15 to 20 minutes on the slides that will be making sure that everyone understands the content. And then what we want to do is we want to spend as much time as possible going through real examples using options play, so that not only can you see what we're showing you in application, but so that you can really get a sense for how to utilize this platform to find bearish opportunities and then leverage them into bearish trades with options and become self-sufficient in being able to utilize our platform and finding these types of opportunities. So this webinar is recorded. Everyone will receive the recording afterwards with the slides. So if you're brand new to options play or brand new to options trading, the recording is really helpful in helping you being able to watch this at your own pace and being able to look at the options play platform along with the recording as you go along. So before I get started, a bit of housekeeping. We're moving this week's webinar to Wednesday because I have some travels coming up, and that means that I am going to unfortunately have to push off next week's webinar to the following week. So we will not have a webinar next week. It will be the week after. And so thank you everyone for taking the time out here on a Wednesday as opposed to our regular scheduled webinars on Thursday. Let's go ahead and get started here. So for those of you that are brand new to options play, just so you understand, you can have access to a free 30-day trial to the tools that we're going to be showing you here today. Membership after the first 30 days is just $50 a month or $500 a year. And you get a free 12-step trading course to utilize this platform for those of you that are beginners and have access to daily options trading ideas. You can sign up using the link that's on my screen, which I just posted into the chat window. So let's go ahead and get started here today. I'm going to start off today by talking a little bit about the current market's outlook. I'll do a very simple price analysis on the S&P 500, give everyone a sense for where we currently stand, what my views are on the markets, and show you, based on those views, what has changed over the last few years as we look at bear markets. And the reason that I want to bring this up again is because as we've been backtesting and scanning for bearish opportunities in the markets, we've noticed that probabilities and returns have really changed over the last few years, meaning it's becoming harder and harder to make money on a bearish trade. So we want to identify what has actually changed so that you understand this, and then talk about how to identify bearish opportunities in the market. Based on our backtesting, what we see works, what doesn't work. And then lastly, talk about what are suitable option strategies to actually take advantage or profit from these potential bearish opportunities. And then we'll jump over to options play and go through some examples and show you bearish opportunities and show you how to analyze the bearish options trades on those opportunities so that you understand how to be self-sufficient in utilizing this platform in finding those opportunities. So with that, let's go ahead and get started. I'll just do a very quick analysis of the S&P 500. This is a weekly chart on the S&P 500, so this is spanning roughly about a year's time. As you can see, we pretty much had this double top around 295 that's been rejected twice, once around September of last year, and once just about a month ago here when it peaked in early May. And we had a recent sell-off, but quickly rallied right back near to that 295 level. Now, this pullback was because of concerns of escalating trade wars with China, and then the subsequent rally because of potentially the Fed cutting rates as things kind of slow down a little. So from my perspective, it's pretty clear that we've been in this trading range between about 260 and 295, 260 being a major support level that did get violated back here in December. That led to a lot of bearish outlooks and thinking that we were about to enter a bear market. Actually, towards the bottom, we were actually more than 20% off the peak, and there was concerns that we were going to get into a recession and kick that off, but that really kind of went right away as the markets rallied right back above the 260 level. I think a lot of people kind of got whipsawed out of this market here, where people went short, got whipsawed, and as things kind of recovered a little, that 260 was resistance. I certainly thought that that was a good level to short, but markets continued to rally higher all the way back up to 295. Got rejected again near that prior high. So again, 295 is the line in the sand for bullish markets to continue. I think this recent sell-off shows some weakness. I think we're seeing some numbers come out of not only the US, but also emerging markets that are a little softer now. So I do think that you have the higher likelihood of a pullback back to 260, or at least the 260, 270 level in the short run. Possibly a break up to 295. I'm not sure what the catalyst would be for that. Perhaps Fed cutting interest rates could be a potential catalyst. At the end of this month, as trade wars with China, if those two somehow be resolved or have major progress towards that, that can also be a catalyst to break 250, 295 to the upside. So those are the key levels that we're paying attention to. But in the meantime, I think we're going to look for potentially a bit of a pullback down to the 260, 270 level. So that's my current view of the markets, and that really helps drive all the other inputs that go into finding opportunities in the market. So before we actually talk about those specific opportunities and how to find them, I want to talk a little bit about some of the things that we've recently seen during market sell-offs. So first of all, just to put things into context, when things sell off, people tend to panic. And one of the things that we really want to make sure people understand is don't panic with every single headline that you see, especially if you're watching CNBC or Bloomberg or the news. We certainly watch those news sources as well, but sometimes things get a little overblown on those things. So one of the things to keep in mind is that 90% of sell-offs are less than 20%. So that is a major, I would say, statistic to pay attention to, is that 90% of sell-offs result in a market sell-off that's less than 20%. 66% of them, 2/3 of them are only about 6%, and 25% of them are about 13%. So if you think about a 6 to 13% correction on the S&P, that comes out to be roughly 2,700 or so to the downside, and about 270 to 250. So right in the realm of that 260 level that I'm talking about is the type of sell-off that we see 90% of the time. Only 10% of the time do we see market crashes that are greater than 20% or 40%. So market crashes or bear markets are very rare. That's one thing to always put into context when things get a little ugly, that they very frequently tend to be mostly what we could call dips and corrections, not an actual bear market or crash. So those are some of the things to consider. And only moves greater than 20% are what we consider an actual bear market. So anything less than 20%, we don't actually consider a bear market. They're either just a dip or a correction, or just what we consider a minor pullback. So again, don't panic every time you see a a pullback in the markets. Second of all, one of the things that we want to pay attention to with the markets is really the probability and return profiles of the market being positive or negative in any single week. And this has changed a lot over the last decade, especially since 2008. Things have changed a lot, but also they've also really accelerated over the last couple of years. So first of all, what we've noticed right off the bat is that there's a much higher probability of positive weeks versus negative weeks. Historically, over the last 30 years, that's always been the case, that we've seen 56% of the time markets move higher, 43% of the time the markets move lower. So there's always a tilt towards the markets moving higher. But as you can see over the last 2 years, that number has gotten significantly skewed to the upside, where 62% of the weeks markets move higher, 37% of the weeks the markets move lower. So what we've seen is that we've got this deviation away from the norm. And the question is, are we going to see kind of a regression back to the mean here? So, and the other thing I think is very interesting to look at here from my perspective is the fact that positive weeks have much lower returns and negative weeks have much higher losses. And this is one of the things that I think has changed a lot over the last couple of years. So you can't really compare these numbers directly to these numbers from the perspective of volatility is quite different, over the last 30 years versus right now. But as you can see, while the average positive return is significantly lower, the average negative return is not significantly lower. So what we're seeing is that, generally speaking, most negative moves are followed by large positive moves. But recently, over the last few years, we have not been seeing that. So when we see these large negative downside moves that tend to happen fairly frequently and very violently, we don't get the upside benefit on the flip side. So that's one of the things that's really important to understand, that's structurally changed about the markets that really affect the bearish strategies that we look at, is that statistics have really changed around these types of strategies. You have a far less probable chance of actually finding a bearish week in the markets, which makes it harder to actually trade bearish opportunities, because if 62% of the time the markets are moving higher, then you're going to have this edge work against you on bearish trades. But flip side, that also means that the edge works for you on positive trades. So that's why, we've focused a lot over the last couple of years on more bullish trades than bearish trades as a result of it. So this is one of the reasons why. Next, I want to take a look at just an understanding of kind of the frequency of moves and understanding as to whether things have changed since 2008. This is something that we talked a little bit about after the December crash, because as you can do during the 1999 crashes, whenever we had this large sell-off. So first I'm going to highlight the 5% line. So when markets move more than 5% to the downside, notice that most of the time it happened, it was resulted in a positive move to the upside. So every single time we saw a move to the downside that was greater than 5%, we generally saw a positive move to the upside. Almost every single time we had a major sell-off, it was followed by a major rally. And as you can see, there was multiple times where the market rallied greater than 5%. Same thing during 2008. After we had this major sell-off here in a single week, it was followed by a couple of weeks where you had major positive returns. And pretty much every single time we saw a net negative return, it was followed by a large positive return. But notice in the last few years, that has not been happening. We've had multiple downside moves that were greater than 5%, but no follow through afterwards that was greater than 5%. So what this means is that, first of all, we're seeing more frequent large violent moves to the downside during normal market conditions, because we're certainly not in a 2008 or a 1999 crash, but we're seeing these negative 5% moves happen with the same amount of frequency as they did during those times. And we're seeing no upside moves to the upside as a result of that. So this is really one of the things that have changed. And keep in mind that this 5% move has been happening during what we consider record low volatility. When you had these large moves to the downside, volatility was substantially higher. Notice how frequently the big bars are during this period versus how small the bars generally here, because the volatility is much lower, but we're still getting the same downside moves. So what that presents us is some opportunities to trade bearish opportunities. However, that has changed significantly, meaning bearish trades happen less frequently, or I'm sorry, bearish opportunities happen slightly less frequently, but they happen in much more violent moves to the downside, given the fact that we are in a lower volatility environment. So those are some of the things to look out for when we're trading. And these are some of the things that we want to make adjustments to as we trade these bearish opportunities. So before I jump into the actual strategies that we utilize for bearish opportunities, I want to talk a little bit about how we actually scan for bearish ideas in the markets, or how do we find bearish opportunities. And we utilize what we call a top-down approach for this. And a top-down approach is relatively simple to understand. We start with looking at the market analysis. This is really looking at like the S&P chart that I just showed you before, and getting a sense for where the markets are. Are they overbought? Are they oversold? And getting a reading on where the markets are, and getting a sense for where we think the markets are heading to. So my analysis initially was that 295, 290 is more of a resistance level, and there's a higher probability that the markets may reverse lower down to that 260, 270 level. Once we have that bearish idea in the markets, then we look at individual sectors. What we want to try to identify is what are the strongest sectors, what are the weakest sectors, and if we're looking for bearish opportunities, we want to focus on the bearish sectors and identify which sectors are most bearish. Once we've identified that, that's when we want to then do individual stock analysis and say, what are the weakest stocks within the weakest sectors? Because those are the stocks that have the highest probability of moving lower on a given week than stocks that are relatively strong in a relatively strong sector. So that is the process that we generally want to try to view when we're looking for bearish opportunities, is looking for bearish markets, looking for weak sectors, weak stocks, and then that generates kind of our sell signal on some of these trades. So I want to walk everyone through kind of an example of this by looking at the market today. And I wanted to take a look at some of the sectors. So I have a bearish bias on the market. So let's take a look at what does a bearish sector look like. So what I did today, before this webinar, I looked at the sector watch list that we pre-populate for everyone on the options play tool. And what I did is I sorted it based on the score of the sectors. And what I get is a listing of the strongest sectors to the weakest sectors based on scores. So energy scanned for as one of the weakest sectors right now. So for anyone that follows the markets, I don't think that is a surprise to anyone that energy is the weakest sector out there. And sectors like technology, materials, and consumer staples, consumer discretionary are some of the strongest sectors. So what I want to do is I want to take a look at the difference between, let's say, the weakest sector, energy, and looking at then the strongest sector, materials, and see kind of what the difference looks like. And this is what I have up here, is two screenshots for you of what the energy sector looks like and what the material sectors look like. So on the energy sector, what I did is I also sorted it by the score. And what I get is all the weakest stocks in the energy sector, and look at the returns for today. -5%, -6.5%, 2%, 1.5%, 4%. While the markets were down just about a couple of tenths of a percentage point, pretty much every single stock in this sector was down on average of 2-3%, some of them moving as high as 5, 6, 7%. So this shows you how you can identify weak stocks within weak sectors that are likely going to move lower, even if the markets move just slightly lower like it did today. On the flip side, if you look at strong sectors and strong markets, such as strong stocks in strong sectors rather. So I pulled up materials. I also sorted it by the score. Notice how when I looked at the highest scoring stocks and materials, even though the markets were down today, notice how most of the stocks and materials were either flat or positive on the day. So this is really showing you how relative strength gives you a sense for, or think of it almost as a roadmap, to give you a sense for where should you focus your attentions on to try to find bullish opportunities and bearish opportunities. So in this particular case, because I have that bearish tilt, what I'm going to do is I'm going to focus my attention on weak sectors like energy, maybe industrials, where, as you can see, the trend is neutral. So even though it has a relatively stronger relative strength, I'm going to focus on it because trend is also relatively weak. Healthcare is another one that I might look at. Financials is another sector that's been relatively weak lately. So I'd focus my attention more so in these specific sectors and then scan for individual names within those sectors to try to find opportunities. And that's what we're going to walk you through here today, is some of those ideas as to how to scan for bearish opportunities in the current market environment. So let's talk a little bit about how to actually benefit or profit from a bearish opportunity. So first, I'm going to start off by talking a little bit about stock trading, because for those of you that are newer to options trading, stock trading is a strategy that you're most familiar with. Trading a stock is easy to understand. If you're bullish on it, you buy the stock. If you're bearish on it, you short the stock. And it's pretty simple because you get immediate gains for both strategies immediately if the direction that you call on it is correct. Meaning if the stock goes up by a penny and you bought it, you will start making money. If it goes down by a penny, you start losing money. So you get immediate gains and losses based on any immediate changes in the underlying price. And this strategy gives you symmetrical exposure, which means that you have dollar for dollar risk. If the stock goes up by $1, you make $1, goes down by $1, you lose $1. So easy to calculate, easy to understand. And you can trade this on any time horizon. It doesn't matter whether you're bullish on the stock for a minute, a year, or a decade. You can buy the stock and hang on to it. The only downside, in my opinion, for trading stocks is the fact that you have no neutral option. Meaning, if I felt that the stock is not going to move much higher or much lower, and I felt it's going to stay near where it is, maybe it's trading near a support level, and I feel that the support is going to hold, but I'm not particularly bullish on this specific stock, and I think it's just going to trade near that support level, there's really nothing I can do as a stock trader. With an options, you have a lot more flexibility. You can trade a lot more different strategies. But today we're going to focus our attention on bearish opportunities. So if you're a stock trader, as a bearish trade, the only thing you can do is sell short the stock. Now, I never recommend doing this because of the fact that shorting a stock gives you symmetrical exposure, which means that if you're wrong, you have unlimited losses as long as the stock keeps moving higher and higher. And we talked about how badly the probabilities are skewed against you when you're shorting a stock. So 62% of the time you short a stock, the markets are going to move higher. So you have this huge edge working against you. And there's always the possibility that you're wrong. So if you're wrong, you have unlimited losses. And that's why I never recommend to a user to short a stock. Conversely, what we always tell users to do is to buy a put or use a put spread, meaning utilize options that give you that downside exposure with limited risk. And the key here is really limited risk. So what I have up here on my chart is ExxonMobil. I picked ExxonMobil because it happens to be an energy stock in the sectors that we talked about, a weak stock in a weak sector. And I pulled it up and I noticed that this stock recently gapped below the $75 level, kind of sold off over the last few days, rallied back straight up to that 75 level and got rejected. So this is a classic rejection at a resistance level. And I think that there's a possibility for the stock to pull back near to that 70 level. So what I looked at is buying a put, because that's really the simplest option strategy you can trade as a bearish view, with a bearish view on an underlying stock. So what I looked at is buying a 2-month put. And what I'm going to do is I'm going to start off by buying an at the money put. So when you're buying a put, generally best practice is to start at the money as a starting point. So a 2-month put here cost me about $3. So what this means is that this strategy will be profitable as long as ExxonMobil is below $72 at expiration. So in 2 months from now, if XOM or ExxonMobil is below $72, then this strategy will be profitable. And the stock's currently trading around 75. So as you can see, the difference between buying a put versus shorting a stock is that not only does the stock need to move lower, it needs to be lower by a certain amount before the strategy is profitable. And that certain amount comes out to be the price that you pay for the option. So if I'm paying $3 for the $75 put, then the stock needs to move all the way down to $72 before I'm profitable. But the flip side on that is the fact that no matter what happens, even if the stock rallies up to 100, the most I'm going to risk is just $3 a share. So because I paid $3 for the option, I'm only risking $3 a share. And that is the flip side, if you will, of buying a put option. Yes, the stock needs to move more in order for you to be profitable, But if the stock moves against you, you have limited losses. And you still maintain unlimited gains below 72. So if the stock goes to 68, 66, 65, if it keeps moving lower and lower, you're going to make more and more profits, just like shorting the stock. But on the flip side, if the stock moves higher, you have limited losses, and you maintain exposure in this specific example until expiration. So until the expiration date. So I'm buying a 2-month put option. I maintain bearish exposure for those 2 months, and that's it. Nothing beyond that. So that is the simplest option strategy that we would ever recommend a user to utilize if you have a bearish view on a specific trade, as opposed to shorting the stock. Now, for those of you that have a bit more experience trading options, we have a next strategy that may give you slightly better returns. And the reason for this is because, like I said, buying a put requires the stock not only to move in your direction, but also by a certain magnitude in order for you to be profitable. So if the stock goes from 75 down to 73, that's not enough to make money on this trade, because the stock needs to move below 72 for you to make money. So you can actually get the direction correct and still lose money by buying a put. And I think that is something about trading options that sometimes confuses beginners and frustrates experienced traders, because you basically said, hey, I called this trade correctly. I knew it was going to go down. I bought a put, but I still ended up losing money. So this is one of the frustrations that I think many people have with trading options. So one of the things that we want to make sure that people understand is, what are the different ways that you can mitigate that? And by doing, one of the things that you can do is by trading slightly more complex trades like a put vertical, because put verticals allow you to take that same directional exposure with a little less risk, which means that the stock doesn't need to move as far in your favor before the strategy is profitable, and it puts less money at risk, which I think is the best part about the strategy. So buying a put vertical, same example, I'm bearish on ExxonMobil, recently got rejected around that $75 resistance level. I feel that it's going to pull back towards that 70 level. So same thing, what I'm going to do is I'm going to buy the same 2-month put, so that 2-month $75 put for $3. I'm going to purchase that for $3, but on a vertical, what I'm going to do is I'm going to sell a 2-month 67.5 put. So I'm selling a put all the way down here, well below the target price that I actually expect the stock to go. And by doing so, what I'm going to do is I'm going to collect $1. So now instead of paying $3 for this bearish trade, now I'm only paying a net of $2. So this strategy now becomes profitable as long as ExxonMobil is below $73 instead of $72, because the stock now only needs to move $2 before it's profitable, as opposed to $3 if I bought the put. And that really helps you quite a bit, because not only does the stock need to move less in order for you to be profitable, you're actually risking less money now per share. So this really is one of the most efficient ways to take a bearish view on an underlying stock, because it allows you to express your bearish views with smaller amount of risk and a greater chance of making money on the trade, because the stock doesn't need to move as far for you to make money. And you have unlimited gains as long as the stock is below $73, just like similar to shorting a stock. The further away, actually, I take that back. In this example, you do not have unlimited gains. You only have gains all the way down to 67.5. If the stock goes below 67.5 by the August expiration, and I apologize for this typo here, if the stock goes below 67.5 by expiration, you do not participate in any part beyond 67.5. If it goes beyond 67.5, you have effectively capped your gains because you've sold that 67.5 put. So that's the flip side, if you will, to the strategy, or the downside. Now, the reason that we sold that 67.5 put is because it's a level far enough from the current price that even if I'm bearish on this trade, I don't think it's going to go down to 0 by expiration. So why am I paying for all that downside? And that's what you get when you're trading a vertical, is that you have a greater chance of making money, but you are limiting your total gains beyond a certain amount of point, and you only maintain exposure just like the other trade until expiration. So that is effectively an explanation as to how to go about utilizing a vertical to potentially maximize your gains by minimizing your risk. So with that, what I just want to do is go through a few different trading tips about trading bearish trades based on everything we just talked about here today. and then jump over to options play to show you some real examples. So number one, I think the most important thing to take away from this strategy, from this webinar, is that bearish trades do not have a probability edge. If anything, you have a probability deficiency when you're trading bearish strategies. So that's an important thing to understand, because a lot of users tend to think of bearish trades as just the opposite of a bullish trade. It's really not. The market statistics clearly show that markets move higher more often than lower. So when you're trading a bearish trade, you have to be cognizant of that. And because of that, when you trade bearish trades, make sure you use limited risk option strategies, because there's a higher probability of the stock moving against you when you have a bearish view on it. So when you're wrong on it, you want to make sure that you limit your losses. And the only way to do that is by using option strategies like buying a put or a put spread that define your risk to what you've paid for that option. The one thing I will point out is that even though bearish verticals or vertical trades provide you with less risk and provide you with a greater probability of making money, bearish markets tend to favor long puts. And the reason for this is because, like I said, when markets move to the downside, they tend to move more violently. And puts, generally speaking, will be able to take advantage of that, versus put verticals have a cap as to how much money it can make on that. So when the markets move significantly lower, and let's say the stock moves down 10% in a week, a put vertical sometimes will cap your gains, versus a put will be able to take advantage of all of those moves. So when you do expect a big move, or you think that there's a potential catalyst for a big move, buying puts sometimes is a better strategy than buying that put vertical, even though it has less risk. So, and then lastly, one of the things that we've learned from trading the markets over the last few years is the fact that when you're trading puts, when you're buying puts, or when you're buying put verticals, you have to take profits early, and you have to roll your profitable trades fairly frequently. So when you gain 50% on your bearish trades, it's time to either start rolling your trades, meaning buying back the puts and buying a new put, so that you're locking in some gains and take profits. And then lastly, you want to make sure that you cut your losses when the stock rallies. And we usually use a stop loss of about 50% on your puts and put verticals to make sure that you cut your losses on these types of trades. You want to make sure you cut your losses very frequently on these types of trades. So those are some of the tips, if you will, for trading these types of strategies. So with that, what I want to do is I want to jump over to options play, and I just want to show you some real examples of trading opportunities and showing you how to look for them in the markets. So like I said, for those of you that are brand new to options play, welcome. This is the platform that you can get a 30-day free trial to. You have 3 panels: trade ideas and watch list and portfolio on the left-hand side. In the middle is our security analysis panel. And on the right-hand side is trading and income. So what we want to focus on today is the watch list, because we have pre-built watch lists for you that scan the individual sectors. So when you pull up your watch list first, it'll bring up the 11 sector spiders, and you can see, sorting it by the score, which sectors are weakest and which sectors are strongest. So because I have a bearish bias on the S&P 500, especially on the strong rally, after these types of strong rallies, we usually get a bit of a pullback. I'm expecting a pullback maybe around to that 270 level. So I'm going to focus my attention more so on the bearish side. You can disagree with us. You can say I'm bullish on this specific market. If that was the case, you want to focus your attention more so on consumer staples, technology, materials, consumer discretionary, maybe even real estate. Those are the types of sectors that I would pay attention to if I'm bullish on the markets. But because I'm more on the bearish side, I'm going to look for energy. I might even look at industrials, because as you can see, industrials, even though it's relatively strong, recently turned neutral in terms of the trends. This is telling me that trend quality is really deteriorated in this specific sector. So even though it hasn't quite turned around yet, it's starting to show cracks. So those are the types of places that I would look at. So one of the names that I wanted to pull up is actually Boeing, because it's in the industrial sector. It's really had what I would consider relatively poor price action. This is completely irrelevant. This is completely outside of any fundamentals that you may have on Boeing, or views that you may have on the planes and the whole crashes. This is completely outside of that. Just price action here looks pretty weak, because 362, as you can see, was a pretty strong support level. 365, strong support level that held for quite a bit through March and April, finally cracked below that in early May. Tried to break back to around that 362, 365 level multiple times and got rejected, and looks like it's getting rejected there again. So this is purely based on a price action thought process that I have a bearish view on this specific trade. And this is really where the trading panel of options play comes to life, because regardless of whether you have a bullish view on this specific stock or a bearish view, you can click on one of these two buttons here at the bottom and instantly see three strategies that already have the expiration date, strike price, and three options for you to take a bullish or bearish view on any stock. So if you are contrarian on this trade and you're bullish on Boeing, you can look at buying 100 shares, buying a call option, or buying that call spread, and the expiration date and strike price are already selected for you based on the best practices that we teach during these webinars. So in this particular example, I'm going to select I'm bearish. So three choices I have is I can short the stock, I can buy a put option, which is the first option strategy we showed you here today, and then the put spread, which is the second option strategy we discussed here today. And the expiration dates and strike prices are already selected based on the best practices that we lined out during the presentation today. So here, shorting the stock will cost me a significant amount of margin to go about doing so, and I have unlimited risk. So that's not a strategy that I'm really looking to do, but I have it up there for comparison purposes. I can buy a put option, which cost me $1,300. So this is the July 26, 347.5 puts, or I can buy this July 312, 347 puts. So these are the three strategies that I'm looking at. One costs $1,300, one costs only $1,000. So Boeing, as you can see, I don't have I have some price history to the downside to look at. So I think 335, 330 is probably a conservative target that I would target, because that's where it was trading just last week. So if I think it's going to move down to 330, that's where I want to use my P&L simulator. This allows you to put any scenario in your outlooks into your simulator and see how each strategy performs, because if you're using an option chain, chances are you might have picked similar strikes and expiration dates. But if I ask you, okay, if you pick that July 26, 347.5 put and the stock declined by 5%, how much money do you make? If you're looking at an option chain, it's really not easy to figure that out. You may have, as a sophisticated trader or an experienced trader, some mental math to do. Here, we actually show you exactly how much money you make. So if you bought this put, you make $385, which is a 28% return, versus only a 4% return if you had shorted the stock. Conversely, on the right-hand side, you make a 700% profit, which is a 66% return. So you can really start to see the difference between these two strategies. So by selling that 312 put, this is basically saying I don't believe the stock's going to go below 312, which is the level that I have here on my screen, by July 26, which is roughly 44 days from now. So in the next 44 days, I'm basically saying I don't think it's going to go significantly below 312. I certainly think it'll go lower, but I don't think the stock's going to go to 300, in the next few days or in the next few weeks. So I think 312 is a reasonable put to sell. And as you can see, if I do that, I increase my returns from 385 to 700. So almost double the returns. And because it cost me less to get into the trade, the returns are actually more than double. And these are the types of strategies that you typically see. And I can say, okay, what happens if the stock moves down to 322, which is that support level? As you can see, things get really magnified. Just that $300 that I saved goes from an 86% return to a 142% return. And conversely, more importantly, let's just say Boeing, for various reasons, let's say there's some good news, they get their planes recertified, they go back in service, the fallout is not as bad as we think it is, and the stock rallies back up to, let's say, 390. This is kind of a worst case scenario for a bearish trade, but let's just say that happens. If I had shorted the stock, I'm losing $4,300. That's a big loss to take on a trade that may have about a 50-50, maybe a 60% chance of working out. Versus if I bought the put option, I'm only risking $1,300, a fraction of what I'm risking if I bought the put or shorted the stock. And the strategy on the right, I only risk $1,000. So I risk the least amount of money here on this vertical. And if I'm right, I make a significantly higher return than the other two strategies. And a lot of people ask, what is the options play score? The options play score tells you the risk to reward of each strategy. So that's why this strategy here on the right gives you the highest options play score, because if I'm wrong, I risk the least amount of money. And if I'm right, I make the most amount of money. Those are the types of scenarios that you want, right? You want to minimize gains, and maximize. You want to minimize losses and maximize gains. And the options play score tells you how well balanced that risk to reward on your strategy is. And this tool is really designed to make this process as easy as possible for you to find a symbol, search for an option strategy, analyze that option strategy, and if it's for you, click on the trade button and enter this trade into your broker's platform. This is designed to make the process of finding a trade and analyzing it down to from a few minutes just to a few seconds. And I want to walk you through a few different examples to show you, how to go about doing so. So another one I was looking at, it was Eli Lilly. So this happens to be in the healthcare sector, relatively weaker sector, and especially if you focus more so on the biotech side. If you look at the biotech indices, they've really kind of declined over the last few months. As the market's kind of rallied higher, these indices have not moved higher. So I was looking at some pharmaceutical stocks like Eli Lilly. Today, as you can see, Eli Lilly recently broke below some support levels here. It recently came back up to about 115 or so, but certainly below support levels here. And I think there's potential more potential downside, maybe around to that 105 level. So what I pulled up is Eli Lilly, looked at the chart, saw that there's some downside potential to the downside, clicked on I'm bearish, and I got presented 3 bearish strategies. And these are my starting points. I can short the stock, buy a put, or buy a put spread. So I'm buying the 116 put and I'm selling the 106 put against that. 106 is just about right here. As you can see, that's pretty much near that bottom that we saw in December of 2018. So I'm basically buying that 116 put because I want that downside exposure, and then I'm selling that 106 put to offset roughly $100 worth of premium. So instead of paying $4.10 for a put, I'm paying only $3.15. So I'm collecting 95 cents, almost $100. And let's see what happens if the stock does decline to that 106 level. As you can see, if it declines to 106, if I shorted the stock, I make a 7% return or 8% return. If I bought the put, 143% return. So if you're thinking about being bearish on a stock, look at buying puts instead of shorting that stock, because it allows you to really magnify your returns while limiting your losses. And lastly, as you can see, the magnification that I get from risking $100 less or taking $100 less to get into the trade, instead of 143% return, I'm looking at 217% return on the spread. And vice versa, if the stock rallies back up to 120, which is always feasible in this market, the Fed could come out and say, hey, we're going to cut rates because things are looking a little weaker now. Inflation is starting to move higher, or a trade war gets resolved magically. If any of these things could happen, and if they do, you could have a significant impact to these stock prices. So the stock rallies up to 120 or even 124, 125. As you can see, shorting that stock, I'm losing $980 versus $410 on the put versus $315 on the put vertical. So again, the reason this put vertical has the highest options play score is the fact that if I'm wrong, I lose the least amount of money, and if I'm right, I make the most amount of money. And those are, again, the scenarios that you want to look for when you're trading in any option strategy or any strategy at all, is to make sure that you're maximizing your risk to reward. And I'll do one last example just to show you how simple it is to utilize this tool. I'm looking at ConocoPhillips, energy stock, really sold off significantly over the last few weeks. Let's say I think the stock, or maybe I'll go to ExxonMobil, because that was the stock that we were looking at before. Let's look at ExxonMobil. Like I said before, ExxonMobil recently just got rejected around that 75 level, trading at 74 right now. I think this stock can easily make a crack back around 70 or so. So if I'm looking at some bearish strategies on ExxonMobil, let's see. So as you can see, shorting that stock will cost me roughly $7,300 in margin. Buying a put option, $216. Buying that put spread, $161. And so if the stock declines to that $70 level that I'm expecting, a 5% return on the shorting the stock, 108% return on the put, 179% return on that put spread. Now, there could be some catastrophic move to the downside. So if the stock does move significantly lower, which we have seen in oil has collapsed a couple of times over the last few weeks. If you do see that catastrophic move to the downside again, so if the stock moves down to, let's say, 65, which is that downside, as you hear around there, 65, notice how the put spread gets capped at that 69 level. So if it goes below 69, no matter what happens, it makes the same amount of money. But the put, if it goes all the way down to 65, will continue to make more and more money. So buying that put will give you that higher return, 340% return if the stock does move down to 65. Highly unlikely, but in the event that happens, the put option will give you that better return. So, but the overall better risk to reward is going to be these put verticals. So with that, that is the presentation that I wanted to show everyone here about understanding fundamentally what's different about bearish markets, how to go about identifying some opportunities for bearish moves, and then lastly, how do you actually protect yourself in these bearish trades by trading limited risk strategies, by buying a put or a put spread, and really utilizing the power of options play to analyze these strategies before you trade so that you truly understand your risks and your potential rewards before you get into a trade, and clicking on that trade button so that you can enter this trade into your broker's platform. So with that, what I want to do is I want to thank everyone for taking the time out here this afternoon, taking a look at some strategies. And what I'll do at this point is I'll open this up for Q&A, and I'll, if you have any questions regarding anything I went over here today, please type them into the chat window, which you can see at the bottom of your screen, or the Q&A window, and I'll answer as many questions as I have time for here today. So it looks like there's a few questions already. So again, if you have questions, please let me know, type them into the chat window. But Kelvin is asking, but the delta is lower and big gains are capped. Kelvin, absolutely. But as you can see, gains are capped. But the reason that we select a strike that's relatively far away is the fact that we are automatically selecting a strike for you that has a relatively low chance of hitting, right? So we're choosing the 69 strike. A 69 strike is all the way down here. And what we're basically saying is that there's only about a 15% chance that this stock will move down to $69 or lower. And that's a pretty low probability. And you're going to collect enough premium to significantly boost your returns if the stock moves lower. And only if the stock goes all the way below, let's see, at what point does the put start to make more profits? The stock has to move all the way down to 67 before the put makes more money. And by then, you have such a low probability of that happening. You have far more probability of the stock being above 67. And if it's above 67, you're going to make a higher return here on the verticals. So you're absolutely right. Puts have a lower delta and it caps your gains. But the flip side is you're risking less money, and 95% of the time, you're going to make more money on that vertical than you do on that put. And that is better for you in the long run. Roger's saying, what variables go into the options play score? The options play score calculates all of these things. It looks at your max reward, it looks at your max risk, looks at probability of profit, looks at the probability of making that max gain, look at the probability of making that max loss. And those are the numbers that we crunch, because when you look at a page that looks like this, how can you tell whether the put looks better or the put vertical looks better from a risk reward perspective? You really can't. So that's why we crunch these numbers into a single number that you can actually read and understand. Bonald is saying, are there archives for previous webinars? Yes, all of our webinars are previously recorded. And what I'll do is I will send you a link. 1 second. So I'm going to send a link to everyone in the chat window. That is a link to our YouTube channel. You can see all of our previously recorded webinars at that link. Bradley's saying, do you have a rule of thumb for stop losses on options? Yes, we generally do have a rule of thumb on stop losses, especially when you're buying. So let me clarify this. This is only for if you're buying options, such as buying a put or buying a put spread. Is you want to cut your losses somewhere around 50% losses is a good starting point. Whoops. 50% losses is a good stop loss level on your options trade is generally what we use here for options. Samuel saying, do you tell us when to close a trade? So for our daily play trades, we do tell you when to close those trades. We send you emails every day at 6 a.m. I believe the one we got yesterday was one to close out Walmart. So we'd send those out to you every single day at 6 a.m. Brian is saying, does the options play score factor into implied volatility and potentially higher premiums when doing long positions? Yes, it doesn't indirectly, because your risk to reward ratio is calculated based on the premium of the trade. So the risk to reward ratio here of 389 versus 161 is based on the premium of that trade. So the higher the premium, the more risk you have and the less reward you have. And that is also factored into the implied volatility calculation. So indirectly, but yes, Brian. Let's see. What is the typical time frame for a stock that is oversold in terms of determining the date of expiration? So good question, Mitch. That depends on what time frame you're identifying oversold on. If you're identifying oversold on a daily chart, you're generally going to find that it's probably just a few days long. If you identify oversold on a few week chart, then it's usually about 4 to 5 weeks. I like to use weekly charts a lot in my trading because weekly charts really reduce a lot of the noise from my perspective. So a lot of the algorithmic signals that we generate here is actually all based on weekly candles, because weekly candles, again, filter out a lot of that noise. And when we get a signal like overbought or oversold on a trade, on a weekly channel, that will usually last about 3 to 5 weeks or so. Roland saying, have you ever released your actual running profit and loss? So Roland, we actually send every single trade. It's available to you at optionsplay.com/dailyplay. You can actually see some of our performance there on that website. I just sent it to you in the room or in the chat room. Stan is saying, can you change a cover call into a spread by buying another call or out if the cover call is losing money? Stan, so are you talking about making, so a cover call, you can't really lose money on a cover call, right? Because you can only lose out on opportunity, but you can't lose money because the short call is covered by the stock, right? So the only way you lose money on a cover call is if the stock declines, but that's not losing money on the cover call, that's losing money on the stock leg. So I'm not sure what you mean by that, Stan. If you're talking about if the stock moves higher above the strike price, can you buy a call to try to make money? Absolutely, you can, but I wouldn't necessarily do that because you're now adding risk to the trade, and you could potentially have the stock pull back and lose money on the stock and the long call. So I wouldn't recommend that strategy, Stan. Any other questions? The call is for 125 and the stock's at 132. Stan, that's a pretty typical scenario to find yourself in. From my perspective, if you don't want to lose the stock, buy back the 125 call, sell to maybe a 135, 137 call now at this point. That's the only way to prevent your stock from being called away. I certainly wouldn't buy a 120 call to turn that short call into a vertical because that's the same as just buying more stock. And you basically risk that if the stock pulls back to 125, not only do you now lose money on the stock, you also lose money on the call that you've purchased. So I don't recommend that, in my opinion, Stan. Bradley saying, in the presentation on the S&P 500, options play as a 1 month and 6 month bullish view trend, but personally you have a bearish view. Do you know historically how often the trend on options play works out moving forward 6 months in the future? So the trend analysis is really telling you what the current snapshot is, right? So absolutely, the trend currently is bullish and no one can argue against that. But that doesn't mean that I can't believe that the markets are going to turn lower. So notice how when the market peaks, the trends were bullish. Just a few days later, on May 7th, as you can see, the markets were 295. It closed at 288 on that day. So less than 2% from the peak caused our trend indicators to turn mildly bearish. So Bradley, I would say that keep in mind that this is the very peak. I think that even if you get a pullback just a couple of percentage points, you're going to see our trend indicators start turning mildly bearish. So our trend indicators are meant to be fairly sensitive, so that even if you have a small pullback in the markets, you start to see that trend quality deteriorate. And that's really kind of what I think you want to pay attention to. So yes, I'm getting a bit ahead of the game here by saying that I have a more bearish view on the trade. But as you can see, I think that if the market does prove to be correct, even by a couple of percentage points, you'll see that reflected in our trend indicators fairly quickly. Victor is saying, do you have a hedge strategy for overall market dropping? Absolutely. We have a whole webinar just on that topic alone. So if you want to use, if you go to our YouTube channel, which I'll send the link again in here in the chat window, we have a whole section. We have a whole video just on that alone. Let me see if I can find it for you here. This is our YouTube channel, and we have a webinar. I think we have a couple of them. So how to prepare your portfolio for a recession is one of the hedging opportunities, but the other one is really,
good afternoon and welcome back.
The other one is how to hedge a portfolio with NASDAQ 100 index options. So we actually have 2 videos on there on how to hedge your portfolio. And you can use SPY for that as well. So Victor, I hope that answered your question. John is saying, why does it seem that most vertical puts seem to lose money greater in one put than the other? The profit never seems to make up the difference. John, I'm not sure what you mean by that. If you're talking about the 2 legs don't make up, what the other one loses, that's because they have different deltas. So the long leg has a much higher delta than the short leg. So it also loses money at a faster pace than the short leg. I think that is what you're asking. Wayne is saying, can you please explain the Burlington trade? Absolutely. Well, let's take a look at the Burlington trade. This was a bit of a opportunistic trade, I would say. Burlington Stores is certainly in a sector that I believe is weakening, which is consumer discretionary. Retail. And if you look at the retail sector ETFs, so this is the retail sector ETFs. Notice how it's really declined over the last few months as the markets kind of rallied. And it really has deteriorated and recently kind of bounced back a little, which from my perspective, any type of bounce back in a bearish market provides shorting opportunities. So number one, I had a bearish view on the sector itself. And then we looked at some stocks within that sector, and Burlington came up as a sector where this 167 level was a pretty critical level as it played around. And also from a fundamental perspective, doesn't look like a very strong stock. And another thing that I will point out is notice on how this rally recently from that 150 to 167 level, a $13 rally, a pretty big rally, happened on very, very low volume and decreasing volume as it kept going higher and higher. So these are all signs that this was a bit of a false rally, and I was expecting that the stock was just going to pull back pretty quickly down to maybe that 150 level. And that's why we took a bit of an opportunistic trade here on Burlington. We looked at some put options, and the put options were pretty cheap, and that's why we put out this Burlington trade yesterday. So that's how we came up with that trade. Any other questions before I sign off for today? If there are no other questions, I just want to again thank everyone for taking the time out here this afternoon. I hope you guys have found the context of this useful, a little different than our typical webinars, but I found that it's really important to also share with you some of the statistics that we find out as we do our backtesting and our algorithmic trading, so that you guys can share in some of that information to understand how to position yourself correctly for these types of markets because things have changed quite a bit. So thank you so much for taking the time out here this afternoon. Again, thank you for coming in on a Wednesday instead of our regular scheduled Thursday. And because I'm traveling starting tonight, I'm unfortunately going to have to defer our next webinar Thursday to the following week. So we won't have a webinar next week, and I'll see you the following Thursday. Thank you so much, everyone. I will send out the recording in about 30 minutes before I head off for the airport. So I hope everyone has a great evening, and I'll see you in 2 weeks.